This is a stock analysis update on Diversified Energy. Before I start, please remember that I do these videos just for fun as a hobby and always speak to a qualified professional before making any investment decisions. Diversified Energy are listed on the FTSE 250. They own a large number of gas assets based in two regions of the US, the Appalachia Basin and also what they call the central assets, which is mainly Texas and Oklahoma. These are all older onshore gas wells which they buy off the gas majors who don't really want them anymore after the initial production phase. Diversified Energy come along, buy them, where they have to deal with the kind of more problematic longer term phase and then the final closing down of the wells and restoring them to nature. This is all stuff which the gas majors would rather palm off on someone else to do. You get much lower volumes, but then the upside is that it's a much more stable profile in terms of the depletion of the gas production that you can expect from these kinds of assets once Diversified Energy take them over. Now, their whole business model is actually based on taking on lots of debt, and then because they've got a well understood future revenue stream, they then use hedging to ensure that they can pay off that debt, plus pay out their dividends and cover all other costs. Demonstrate that. Here we see the gas price, and the black line here, this is the average price which Diversified Energy got for their gas on each year. And then the blue line is the price they got when you then take into account the hedging that they did. And we can see that normally about 85% of their position of their revenues are hedged for the following year, with that amount reducing to about 70% when you go 2 years ahead. And in this graphic here, I've put their revenues over recent years, and then against that is their general running costs, but then the impact of the hedging, which has been settled within each particular year. And then you get this nice skim where over the course of time, they do get a nice little margin there, which they can use to pay their dividends. We're actually talking about 15% dividends at the moment, which is quite attractive. But then they are also highly leveraged, and I'll be going into the debt in quite a bit more detail later on. But the big question is, now that we're in an era where debt's a lot less cheap, is this going to cause problems for Diversified Energy? So here's their share price, and it's kind of very roughly flat. And of course, the way that this company operates, where they do this hedging, you're buying this company more because you want the large dividends, not because you're expecting the share price to go up. So taking a look at their price on TradingView, and actually they are actually in definitely a downtrend. This does kind of coincide with the change in debt situation. So you have to wonder, is there a bit of a connection there? But if you do like them, they are possibly at a slight bargain at the moment compared with the historical price when they were kind of flat. So what I've done is there's so much information coming out of them that in this slide I've got the financial related information, and then on this one I've got just more big news items. Diversified Energy, they initially listed on AIM when they raised only 40 million, and then that was in 2017, and by 2020 they had listed on the FTSE 250, and that was with a 770 million market cap. So it's really impressive that they managed to grow this company from just 40 million in 2017 on AIM to 770 million with the FTSE 250 listing in 2020. You can see that historically they tended to raise money just by doing share issuances. And then however, from 2021, they moved to using more the raising of debt. They always had this credit facility, but that was raised by 200 million up to 625 million in 2021. So in 2021, they were using revolving credit facility, which had a interest rate linked to SOFR plus a kind of modest 3.75%. Now, of course, back here, the interest rates were very low. And in 2022, all of a sudden, we saw interest rates go up. And so Diversified Energy responded to this by basically paying off all this SOFR debt, the revolving credit facility debt, and instead raising asset-backed security notes for which they have to pay interest of roughly between 5 and 6%. Now, here I've summarized all of their existing debt by the end of 2022. And here you see the this SOFR linked credit facility and how they'd moved from there into all these asset-backed security notes that they have that run out for quite a few years. It's a bit alarming, however, that in 2023 they seem to start leaning on the credit facility again a bit more. They announced also a 97 million share buyback, and in fact, only the other week on the 5th of September, they did 150,000 worth of share buyback. So they're obviously quite confident in the health of the business, but to the same token, I'm a little unsure why they're doing share buybacks when they've got debt linked to interest rates. Another thing that started happening in 2023 was they started selling off little pieces of their assets which were not considered core, with about 56 million of divestments. So away from the financial side, and big news items were, apart from the listings on the AIM and the FTSE 250, was in 2020 they achieved this deal with Oaktree Capital Management. Oaktree are capital managers with good reputation, so it was quite impressive that they managed to strike this deal where Oaktree can put in up to £1 billion worth of investment in a kind of joint investments on new projects. And then over the course of the last few years, there's been a lot of acquisitions going on. They've bought the Blackbeard, Tanos, Cotton Valley, Tapstone, East Texas, Central Region, and Tanos 2 assets. So they really have built up their portfolio quite a lot in the last few years. So one other thing that stands out about their previous history is Bloomberg Gate scandal. So in 2021, Bloomberg came out with this article which they call a Empire of Dying Wells. They did a bit of a hit piece on Diversified Energy. You can see here some pictures from that article. And what they did was they went round to some of Diversified's projects and found the eldest, worst looking old gas wells they could find. And then they did this hit piece article where they were just saying how evil Diversified Energy were. And they did do some gas readings, and apparently some of their wells there was some methane there, but based on the rebuttal which Diversified Energy came out with, I believe that when they did this hit piece, some of these images you see, they're just where they found the worst images they could. They might not necessarily be particular sites where there was actually gas leaking. But anyway, Diversified reacted to that. They turned really one negative into two pluses because they bought this asset plug-in contractor company in 2022. And now they're going full out on the retirement of the wells, and they are bringing forward that they actually excel in that area now. So looking at their profit and loss statement, we see that the income in terms of the revenue does increase quite a lot since 2017 as they've built up the business by taking on debt. And the operating expense and depreciation and admin expense doesn't seem to be creeping up too badly as a proportion of the overall revenues. The derivatives I'll come back to, but then you've got the finance costs where we actually do see quite a large number of 101 million in 2022. But I believe this is because they did this switch from the credit-based facility debt to all of these asset-backed securities, which I think was expensive. And then the asset retirement, this is what they're all about now, following that Bloomberg scandal. An interesting thing is the tax, because a lot of their resources are end of life. In order to protect blue collar jobs, the government likes to pay tax credits if you run those kinds of projects, if your business is running at a loss overall. So what happens is that when they make a loss, and in the case of the last few years, that's been because of the derivatives going the wrong way, or the gas price going up. When you do make a loss, you then actually get these tax credits where you don't pay the tax now, but you wait for the future. And then because that then goes on the balance sheet as a asset, as deferred tax, that is then treated as a credit, which is why it's a positive number in your balance sheet. Taxes in the expenses column. That's why this has got a negative number, but you know what I mean. So that is actually a significant effect, and I think an important part of their business model. Then more important than that is, of course, the derivatives. So here we've got these absolutely huge numbers in terms of derivative expenses, which were 1.8 billion in 2022. So as you can see in 2022, the gas price went up massively, and they were hedged for lower prices. So then that creates a massive negative number in terms of the derivatives that they have to settle that year. So then that leaves you with these absolute haywire numbers in terms of their net income. Here's what that looks like graphically. But what it means is that because of these derivatives effects, you can't really assess this company using their operating profit and net income, because the effects of these derivatives just make a complete nonsense over that. And so that's why I did this graphic where I have the revenues, and against that their running costs and the hedge impact. And this hedge impact only takes account of derivatives that were settled within that year. As you can see from this extract from the annual report, in 2022 there was 1.8 billion of negative derivative effects, but actually only zero point 0.9 billion of that had to be settled within that year. The other 0.9 billion, those are movements that have gone against them, but which they're not going to have to pay until future years. So when you only take into account the amount that was settled that year, that's how I then come up with this graphic here, which does sort of make sense in a way that just isn't possible with their profit and loss statement. So moving on to their balance sheet, and we see this impressive build up in assets as they've completely continued to build their portfolio. And the vast majority of their assets are these oil and gas assets, plus some of the property, plant, and equipment that's all part of that they use to extract that gas. The other assets are kind of fairly negligible, apart from this deferred tax, which, as I said before, is whenever they operate as a loss, they do have then the benefit of building up these deferred tax assets. Then looking at the current assets, and it's mostly just trade receivables. So generally, it's actually a fairly healthy asset mix, and it's dominated really by actually their oil and gas properties. And the asset retirement obligations here, that's all of these old wells which need to be restored back to nature. And I suppose the overall number isn't too onerous at the moment at 0.4 billion. Then, of course, the most significant thing is the debt, as well as any unsettled derivatives. At any given time, of course, they'll have some derivatives that are going well for them, and some which are working against them. Interestingly, when I look at the 2023 interims, in terms of short term, they have slightly more better derivatives. So they're kind of net plus about 20 million in terms of their derivatives balance. But then in the long term, they are actually still they've only got 36 million that are going their way versus zero point 0.7 billion still going against them in the long term. So yeah, I wonder if there's something in that. But yeah, overall, I suppose the worst thing about their liabilities is this long-term debt that they've had to build up. And I've gone through that obviously before, and here's the makeup for that. A bit of a unwelcome shift to the credit facility here, but I don't know if that's because this is just a 6 monthly, and it will be good to look at the full year to see if that's just because they're halfway through the year and they've moved it, shifted it there before paying it off or whatever. A bit too much is in the short-term credit facility for my liking. And in terms of debt payment schedule, see that zero point 0.3 billion had to be paid within a year, and zero point 0.8 billion over the course of the next 5 years. So unfortunately, when I do my graphic for Diversified Energy in terms of their assets, and then use that against various valuation metrics, they look an absolute haywire mess. But this is because of the kind of company they are, because of the way they're structured. We get these ridiculous situation where in 2022 they actually had a not applicable or negative price to book, and that's the first time I've ever seen that. And then, of course, it radically changes. Then this year, their debt is pretty much their debt is more than their revenues. But of course, this is because of the way that they're structured, where they use this hedging effect. But unfortunately, it just makes a complete nonsense in terms of valuation. Now, one thing is they say that they have a PV10 value of 6.1 billion. However, that's the only number we get in their annual report. There's no breakdown of that, and there's no competent persons report or anything. There's no way of actually verifying yourself that number. So you really do have to take a leap of faith that this PV10 value is correct. But if it was correct, I've got here, you see their market cap of zero point 0.8 billion. So when you stack this 6 billion PV10 against that, then you could argue that based on their PV10, they're undervalued by a factor of 6. Another thing is I've took their PV10 values throughout time and plotted them against their total liabilities, which is comprised of their debt plus their derivative liabilities. And then when we make this, we do get a nice, perhaps, appraisal of how they are accumulating these assets, which then they're going to be able to turn into revenues over a long period of time. So just for this basis, yes, you could say they were undervalued, but then you've got to take a leap of faith in this PV10 value. So it's very awkward to try and evaluate Diversified Energy's performance because due to this, how they work with the hedging, their profit and loss statement just comes out with absolute haywire garbage, and their balance sheet again just comes out with complete haywire garbage because of the way that they're set up. You just can't really evaluate them as you would a normal company. And so I think the best way of understanding them is actually through their cash flow, and in particular an understanding of what's going on in terms of the reconciliations of their cash flows. So with the cash flow, you always start with this cash flow from operating activities. As you can see, that zero point 0.6 billion number there, that matches the 0.6 billion net income. And what you've got to realize is that that number does involve a lot of things that are cash flows, and a lot of things though that perhaps, although they are a profit or a loss on the profit and loss account and loss statement, they aren't actually a real transfer of cash in or out. What you do is you start with the raw numbers as found in the profit and loss statement. So we have there 1.9 billion of revenue, and then these costs of zero point 0.4 billion operating expense and 0.2 billion general and admin expense. So there you go. There's the 1.9 billion of revenue and 0.4 billion operating expense and 0.2 billion plus this huge negative 1.8 billion number in terms of their derivative financial instruments, which you can see matches this 1.8 billion here. Then there's the non-operating costs, the finance costs, tax credits, which then leaves us with this number as per the profit and loss statement of cash generated by operations of negative 0.6 billion. But then, of course, in this reconciliation part, you've got to then cancel out those things which, although they appear here, in reality, no money actually did come in or out of the business. So with the tax credits, for example, although that was a credit of 0.2 billion in terms of their profit and loss, they didn't actually receive 0.2 billion. It's just an accountancy thing where that money shifts onto their balance sheet, and so you just have to take account of it here. So depreciation is another example. So there, although on your books the depreciation of your assets comes as a loss, in reality, no money went anywhere. So in terms of this cash flow reconciliation, we then have to credit that to cancel out what wasn't actually a real cash flow. And so, of course, we do these this reconciliations, and the most important one, of course, is the unsettled derivative. Like I said before, only zero point 0.9 billion of those derivatives were settled in 2022. The other zero point 0.9 billion, they're going to have to be, although that was a negative impact or a movement in the valuations, which has to be treated as a expense. In reality, no money actually got paid out for that. It's for something in the future. So in terms of cash flow reconciliation, what was a negative 1.8 billion in terms of the derivatives, in the reconciliation, you now have to give them a credit of 0.9 billion to take out the stuff which you didn't actually even pay in 2022. And that's the most important difference. One, there's also working capital adjustments, which is just which is mainly just the difference between the current assets and liabilities between years, which has to be reconciled as well. But then after that, and that's only really a minor effect. We are left with this cash generated from operations of 0.4 billion. And so it's important to actually go through that third step to really understand the quality of these cash flows. And indeed, these reconciliations do make sense. And when we particularly take account of the unsettled derivatives, we can start to believe in these zero point 0.4 billion of cash generated from operations. And with that 0.4 billion, but then of course there's the complication that in each year they take on new debt and they pay off debt. So in 2022, they took on 2.6 billion of new debt, but then they paid off 2.1 billion of their debt. So that's actually 0.5 billion of new debt they took on. So they used that 0.5 billion difference of new debt to buy new assets and also buy some capex. And this zero point 0.4 billion of cash, well, they do spend 0.1 billion of dividends and then 0.3 billion of paying the interest on their existing debt plus other debt costs. So it does actually very roughly all square up actually in 2022. But of course, I think what makes 2022 an unusual year is that because they were issuing all these asset-backed security warrants, that's why they was in this situation of having to raise 2.6 billion of new debt and then paying off a massive 2.1 billion. So hopefully we can then look at the cash flow situation for the 2023 interims, which is a kind of a more normal year. This is more back down to the more normal gas prices, where they actually get a positive hedging effect. And so in the for the interims of 2023, they're now at a net income of plus zero point 0.6 billion. We see that a lot of that's from revenue, but then also they had a big input from the derivative financial instruments, which obviously went in their favour this time. And then all these other costs, that in the end left them with about zero point 0.6 billion of cash generated from operations. So then when they then start doing the reconciliations, there's all the bitty stuff which has to be cancelled back. But we see the actual biggest effect is actually having to cancel out their unsettled derivatives. And in fact, here is their interim report. And what we see is that, very interestingly, when we come to the 6 month period, they only actually had a gain of 51,000. They only had a gain of 51,000 in terms of settled derivatives, but it was the actual unsettled derivatives which were the gain of roughly zero point 0.8 billion. So that is a large number that then has to be cancelled out. And so that explains why this huge positive number of zero point 0.8 billion then gets radically cancelled out because it's all unsettled as yet. To actually leave them with a number of only 0.2 billion. So then once you factor in a rounding effect and the working capital adjustments, they only had zero point 0.2 billion of cash generated from operations. So then 2023, now it's kind of nicer to see more sensible kind of debt numbers, but they rose 0.8 billion of new debt, but then paid off 0.8 billion of debt. And then they actually used a equity raise. So there's been they've gathered together zero point 0.2 billion of extra cash using a equity raise, and then that's been used quite neatly to buy zero point 0.2 billion of new assets. So then this means that from this reasonably understood 0.2 billion, they can actually quite comfortably pay 0.1 billion of dividends and then 0.1 billion of interest and other debt costs. So they have again, kind of covered their nut. We start to make sense of this company from understanding better the cash flows. So I thought I would try and improve on this kind of cruder graphic with this knowledge of the increased knowledge of the cash flows, where I accounted for pretty much everything. So this thing I'd done before, it only really accounted for the hedge impact plus other running costs against revenues. So now that I'd kind of gained a better understanding of the cash flows, I've started to tot that together. But before I go into that, there's just one other thing, which is shareholders. So here's the shareholder composition of Diversified Energy, and it's not actually changed much from when I did my last video. Yes, so back to this, and I was still not quite satisfied with this representation in terms of really getting my finger on how well this company was doing. What I think actually makes it so complicated is they're continually bringing in new money in order to pay off debt and then buy the assets. So that completely obfuscates really what's going on with the cash flow. So what I've done here is I've got just the revenue, and then against the revenue, so I'm not considering new debt that they've raised or new equity. I'm just looking at purely their revenues. On the other side, I am looking at all of their negative cash flows, but keeping out any that they've used to buy new assets. And then from doing that, I do get this nice dosh in and dosh out graphic, and we see that the total dosh in always matches the total dosh out. So you can't see the dosh in blue line hidden beneath that black line. So that's good because that means I don't got my maths right. But more importantly, when I show just the revenue and then compare that against the costs they've incurred in that year minus what they've put out to buy new assets, I then do start to see something I can use here. And interestingly, you'll see how historically they always had a reasonably attractive, a fairly decent bit of padding there. But then in 2022, all of a sudden, it's gone wrong, and then we're kind of still recovering now in the interims of 2023. So I also got percentage numbers. So this is the percentage of their cash flow when you don't include the new debt or new equity after taking away what they've spent on new assets. And you see historically, just like you see here, there was a quite healthy number between 10 and 30%. But then in the 2022 full year, all of a sudden it goes wrong. It's a negative 3% number. Now, I calculated that you'll see that actually a big anomaly here was their cost of debt jumped up massively. And that was actually, I believe, linked to the fact that they had to set up all these asset-backed security warrants, which is, not cheap to do when you first do it. So I think those could be some one-off expenses there, and without that, they would have had they would have actually been a plus 6% number, and then so far in their interims they're at 5%. Now I looked at their debt repayments, and then based on that, for me, assuming they weren't going to hide it or obfuscate it by raising new debt or new equity, these are the payments they're going to have to pay out, which they haven't had to pay out this year. So when I account for that, it's actually, quite a nasty number. And then, even without that, even if they weren't paying that, they're still at this lower number of about 5%. I kind of feel like I need to wait for this could be something I don't understand about how they report interim versus full year. So really, I need to wait till the full year to resolve this anomaly in my mind. That they haven't started to go into regular negative numbers. But even if you give them that, we see that now they seem to be making a much smaller cash flow margin, um, in terms of the difference between their revenues and their costs, not including buying new assets. There's definitely a sea change there, and that could be because of the change in lending environment. They can't rely on near zero interest rates anymore. Plus the 3% they were paying. They've now got these perhaps more onerous fixed percentage amounts. So it could be that the debt's what's caused that. Another thing is, though, it could be that obviously in 2022, this company is all geared for lower gas prices. So it could well be that the high gas prices of 2022, they're not geared for that, and so it's going to hurt them, and that's exactly what it did. However, the positive there would be that now that we're back to the lower gas prices, or even maybe the ultimate thing, which would be longer term slightly higher gas prices, it might be that these low numbers are still the unwinding of those hedging positions, and once that unwinding has completed, maybe then we'll see this number pop up back to the 10 to 30%. So I can now kind of wrap up this video analysis of Diversified Energy, a very interesting company that pay very nice dividends, but which are very difficult to understand how they work. I've used this approach where you can kind of understand that once you take account of the hedging impact, they do actually, regardless of whether the gas price goes up or down, they do get a nice kind of skim here. Based on their PV10, they do kind of look impressive, and there is potential that they could be undervalued, maybe by a factor of 6, going on their PV10. But then you've got to take that leap of faith in believing their PV10 if you were to go on just that. Company, though, is fairly impossible to understand through the normal means of looking at the profit and loss statement or their assets. It just comes out as total gobbledygook. The only way to understand this company is through its cash flow. And they have kind of covered their nut in 2022, as well as the interims. I then went into a lot more detail, though, into their cash flow, and found that actually there is a trend as of 2022 where their margin of greatness is much reduced. And I'm thinking that part of that is down to their change of debt profile, but it might also be because we've got to wait for the unwinding of these really nasty effects that happened when we had the higher gas price, because the way that this company's geared up is to operate at lower gas prices. So it might be that we have to wait for the unwinding of those derivatives effects, and then we'll go up to a good number. Or it might be that the with the debt environment, things just aren't working like they were back in the zero interest rate days. There's also, I'm a little concerned it might be I have to wait for the full year, and it could be just an interim effect. But also, when I look at their debt payment profile, that gave me a bit of a yellow flag as well. But like I say, I really want to wait for the full year results to confirm that. So when I started out looking at Diversified Energy, I really wanted to tell you how clever I was, how I'd sussed them out, and I was really, wanted to actually invest in them for the great dividends. If I could have demonstrated that I could understand them, but the market didn't. Sadly, although I definitely have learned a lot about cash flow reconciliation, learned a lot about this company, there's still a few yellow flags for me to eke out, and I just need to wait for the full year results and see if these effects I've seen are a permanent sea change, just the reverberation still from all this craziness that happened in 2022. So for me, they stay on my watch list, but I still haven't quite got to grasp with them, and I need to wait for some more data before I'd go in. So I hope you found that video useful, and good luck with your own investing. Please read the disclaimer. Remember that prices can go down as well as up.